So I want to continue, you guys, actually on a good note. I went through your tests, I checked your tests, I just got to photocopy them and stuff and not forget them. But they were actually all pretty well. Interesting how every group, you guys are a smaller group, but every group is a little bit different in terms of what you're picking up and what you're not. And everyone was kind of consistent in some things that you didn't pick up. Part two, I think most people pretty much got down well, and we did little practice. It's funny because the last group, I had to do tons of practice, and people still botched a lot of it up. So again, it's funny how different it is. Most of you guys got the balance sheet, which was great. So that's good things. Little things here and there, little things about the Q&A in the beginning, here and there. We'll go through it. I can go through the whole thing. I'm just going to try to find a good time to hand it back. But I want to continue what we talked about last week with valuation with the DCF. And remember, we were in the middle of the DCF. If you recall, the three major methods of valuation, this is something that you just want to start committing to memory, right? Comps, P-page, DCF. Remember the idea, the benefits, the drawbacks of each is to approach a purchase price of an entity, right? And we talked about how it all results in a series of multiples. So we talked about different types of value. Book value versus market value, right? Book value is from a very abstract perspective is the value of an entity as written up by its books. We talked about like the example of a used car, and the equivalent of its books is balance sheet. Versus market value, what somebody would pay for the company today, and there's a couple ways to look at that. One is the stock price. Another is precedent transactions, right? What people have paid for the whole business entity in the past, or similar entities in the past. That's market value. And then we kind of broke it down further and talked about like these multiples that are important to understand relative valuation, because if you're comparing several companies and they all have, you know, a little bit of varying values, how do we compare these companies? How do you compare a $10 million company versus a $12 million company? Does a $12 million company look better, or is a $12 million company worse? How do you think about that? And the result is, well, you have to compare those values to some sort of operations that's being produced. You have to compare market value to net income, or you have to compare. So we talked about these multiples as a means of comparison. And these multiples then really have no meaning without comparing them to other multiples. Right? So you look at a bunch of companies that are similar to you, and if they all have multiple market value and net income multiples of like 5, 6 times, and then your multiple is like 7 or 8, that might mean that you are highly valued compared to the market. If your multiple is like 1 or 2, then your value is low. So it's not about the abstract value, it's the value compared to what's being produced. Value to net income, market value. And they also thought about, well, that's net income. What if you believe in a better underlying metric for comparison? Not net income, something like EBITDA. Why would we look at EBITDA versus net income?
Because EBITDA is about how do you relate it to your operation activities.
Exactly.
You guys know.
EBITDA is a better proxy of your company's operations. EBITDA is just revenue, COGS, OPEX, it's your operations. And forget about depreciation and interest and tax, things that are maybe, you know, a little bit more about the financing and the setup of the structure. What about just the operations of the business, EBITDA? So a lot of investors say, listen, I don't care about market value and net income. To me, net income isn't the right value. To me, it's EBITDA. Well, because EBITDA is before interest, before taxes, it's before the capital structures in place, you can't compare that with market value. You can't have a market value to net income multiple. Sorry, market value to EBITDA multiple. If you're looking at an underlying metric that's before interest, EBITDA, then the numerator, we have to add back the debt, market cap plus net debt. And market cap plus net debt is enterprise value. So here we have enterprise value multiples that you can use before net debt to compare to underlying metrics that are before lenders have been paid. Sales, EBIT, EBITDA. Okay? Now, these sets of multiples are outputs of the three major methods to value corporate entities. So we're going to go through these from a process perspective. I'm not going to go through the whole thing, but just as a brief overview. Comparable company analysis compares companies, your company, to other companies that are similar in size, scope, scale, geography, product mix, right? And what we do is, and we'll do this, we'll start this towards the end of the week into next week, we'll look at 6 to 12 companies that are similar to our company based on those criteria. And we'll run multiples. We'll look at multiples, all different multiples. We'll look at enterprise value to EBIT, enterprise value to sales, enterprise value to EBITDA, market value to net income, and we'll look at different time periods. We'll look at LTM multiples. We'll look at current multiples. We'll look at future multiples. And we'll hopefully come up with ranges that will give us an understanding as to how our company is valued relative to its peers. Okay? We'll show you how to do that. So benefits and drawbacks of these. Okay? The benefit of a comparable company analysis is it's, of the three, the one that gives you the most current method of value. It's all based on last night's stock price close, or you can do today's stock price, whatever the last trade of the stock price. It's the only one that's all based on current information. Disadvantage, it might be tough to find comps for your company. Walmart's a great example. Walmart is so big, although its competitors from a business market saturation standpoint is Target, Costco, they're just so much smaller than Walmart. From a financial perspective, are they really appropriate comps? We'll look at that. That's a disadvantage. Another method is precedent transactions. Precedent transactions is comparing the acquisition of the entire company and looking at acquisition multiples. So, now here's a whole lot. There are market multiples and there are acquisition multiples or purchase multiples. And an acquisition multiple or a purchase multiple is a multiple based on how a company is being acquired. So a good example of that is, so in other words, it's the same formula, market value to EBIT, net income, or enterprise value to EBITDA. It's the same types of multiples that we run, but instead of market value, like stock price times share outstanding, it's purchase price. It's purchase price to net income. Or the enterprise value equivalent would be purchase price plus net debt divided by EBITDA. These are the multiples we'd look at, which gives us an idea of how much what the price paid for the entity has been. Okay? So we're going to take a look at historical transactions that are similar to the company that we're valuing. So if we're valuing a big box retailer, we're looking at past transactions that are acquisitions of big box retailers. And we ask ourselves, how much did that person or that entity pay for that business? And if they paid 5 times EBITDA, then our company might be valued at 5 times EBITDA. Benefit of this, so again, it's like the comps, it's like a table of multiples, but different perspective. These are purchase multiples. These are based on acquisitions. They're not market multiples. Benefit of this is these multiples actually include a premium. So if you are actually truly looking at buying the business and you're doing like an M&A analysis and you have to figure out a premium, this will help you do that. Drawback to precedent transactions is it's a dated analysis. Transactions have happened in the past. Usually we run precedent transactions based on the announcement date, and once a deal is announced, sometimes it's 6 months to a year to 2 years to close. So this stuff is always going to be dated. So if you're running this analysis, you always have to have in the back of your mind, well, this might have been done, these multiples might be reflective of a different market environment than today. Think about that. Another drawback is precedent transactions are very difficult to find. Now M&A activity has been pretty good the past couple of years, but prior to that, M&A activity was pretty poor. It might be tough to find past transactions. And if you do find past transactions, it might be very, very difficult to find the underlying information supporting those transactions. So a lot of times these tables, you see a lot of NAs not available, so we'll look at that. Sometimes this analysis is thrown out. Let's see. Okay, that's precedent transactions. And then third, what we've been looking at is the discounted cash flow analysis. This takes the company's cash flows that we projected out 5 to 7 years, discounted back to present value. which is the implied value of the business for the number of projected years. So we project the company out 5 years, discount it. That gives us the value of the business basically for the first 5 years. And then to get to the value of the business from that last projected year up to infinity, to get a total value of the business, we need to apply what's called a terminal value. Terminal value is the value of the business from year 5 or year 7 to infinity. So we take the present value of the first 5 years of cash flows and we add it to the present value of the terminal value, and that's the value of the business. Benefit, most technical. It's based on our model. Drawback is, although it's based on our model and it's the most technical, after year 5, the terminal value, that's a little bit looser. That's not as robust as, oh, it's based on your full operating model. So, but it still is more technical than, let's say, the comparable company analysis, which is just based on market value versus stock price, you know. So as you know, we talked about the way to build up discounted cash flow. We talked about how unlevered free cash flow is really just a simplification of the cash flow statement. So we spoke about that. We spoke about, and I don't want to do the whole thing again, but just generally, that unlevered, if you look at, and it's important to think about this way because it helps you understand when to include other items and common problems with sign direction, right? Do what the cash flow statement does, right? Because basically what we're doing is, if you look at a full income statement, if you look at the full cash from operations, cash from investing, cash from financing, and you want to convert that into unlevered free cash flow. Unlevered free cash flow is free to all equity holders, lenders, so void of capital structure. So we basically wipe out every component, every line item related to financing activities. We want everyday cash flow that's from everyday operations, everyday activities, so we wipe out all of the one-off line items, anything related to one-off M&A or investing activities, with the exception of CapEx, because CapEx is the one investing activity that is sort of related to operations in terms of this is a majority of this is required to maintain your property that's going to produce more operations in the future. So we basically have your cash from operations less CapEx. That's basically the biggest portion of it. However, so when you simplify that, that's basically all your cash from operating activities, which is net income plus D&A plus change in deferred taxes plus other non-cash items plus change in working capital. Side note: not everyone got this on the test yesterday. Cash from operations. These line items: 1, 2, 3, 4, 5 line items, 1 point each. Very simple. A couple people missed these things, missed 1 or 2 things. Got your cash from operations. Less CapEx. Okay? Then the only difference is net income is not completely unlevered because it has impacts of interest income. So you need to add back after-tax interest expense, or interest expense. So actually, if you simplify that, unlevered free cash flow is net income plus depreciation plus change in deferred taxes, other non-cash items, working capital, CapEx, after-tax interest expense. That's unlevered free cash flow. And again, don't be confused about change in working capital. A lot of people say, well, some textbooks say minus change in working capital. Not if it's coming from the cash flow statement. If it's coming from the cash flow statement, just do whatever the cash flow statement does. If I were to minus that, I'd be double counting. Absolutely. But then we say, okay, well, a lot of times unlevered cash flow isn't started with net income. Sometimes you start with EBIT, and there's a good reason for that. You start with EBIT because in a lot of unlevered cash flow analyses, you kind of think, okay, why project all the way down to net income if you're going to add back a lot of those items anyway, if you're going to add back interest, if you're going to add back a lot of these pieces that kind of get you to really to EBIT. So we start with EBIT. And if you start with EBIT, we can get to the same number that you would have on the left side. We would have gotten the same number, okay, by adding depreciation again, adding deferred taxes, adding other non-cash items, adding change in working capital, less CapEx. The only difference is EBIT is already before interest, so you don't have to add back after-tax interest. But net income was after taxes, EBIT is before taxes. So we need to apply an impact on taxes to EBIT. And it's very important to note that you're not getting taxes from the income statement. It's EBIT times tax rate. You want EBIT times tax before interest. You want taxes before the impact of interest. And that gets you to unlevered free cash flow. So we did this in the model. Projected out 5 years, if you remember. We discounted it by a factor of 10%, just completely random for now. We're going to work on that today. And then we looked at terminal value. Now there's 2 ways to calculate terminal value. And my recommendation is to do both and cross-check them. They might not always be the same. Theoretically, they could be. We'll talk about the differences. They don't make sense right now because we don't have a proper discount rate. But the 2 methods for calculating the terminal value is the multiple method and the perpetuity method. The multiple method is taking the last year EBITDA and applying a multiple. The multiple can come from the comps. I conservatively used the current multiple as the exit. And we discount it back 5 years. Very simple. The implication of the EBITDA's terminal value multiple, the idea is, well, applying a multiple to year 5 EBITDA, this is like a sale price. We'll see this in LBO. We'll do this a lot in LBOs. Sell the company after year 5, multiple the EBITDA. We discount that value back 5 years. Whoever we're going to sell to in year 5, that's the value to us. The other way, the more textbook method, is the perpetuity. Mathematical series. This is the value. Take the last year's unlevered cash flow, the non-discounted version, times 1 minus tax. Sorry, times 1 plus G, divided by R minus G. R is the discount rate. G is some base rate of inflation. Some people say textbook is 3 to 4%. I think that's too high. In practice, we've used things as low as 1%, maybe even 0.5%. So determining growth rate can be difficult. Okay. So whatever terminal value we decide, we take those terminal values, add it to the base value, and that's our total value. So where we left off, if you recall, we just took all this information, is to take all of these line items, and we basically pulled them from the cash flow statement, except for taxes, which we calculated, EBIT times tax rate. Added them all up, discounted back, and we summed up all those cash flows. Okay. We then calculated terminal value 2 different ways. EBITDA final year times the multiple. The multiple we just took, we calculated, if you remember, we calculated just the current year's enterprise value divided by multiple. Okay. Divided by EBITDA, sorry. Gave us a net present value. And then unlevered free cash flow, we took the unlevered free cash flow, undiscounted before discounting, grew it out at 1%, and used the perpetuity formula to get the value based on the perpetuity. Correct? And if you look at the box underneath tries to determine what the total value of the company is based on each method. Each method gives us different values. Let's do that now. Okay, so we take the total, the sum of the present value of the cash flows, and we add it to the respective terminal value. So the total present value of cash flows is the 59,523. And the present value of the terminal value for the EBITDA method is the 226,761. So take that. Kevin, I don't know if I understand your question. The way we add back D&A and subtract working capital is kind of like free cash flow. Yes, the free cash flow. It exactly is. And just we spent a lot of time on that. I want to encourage you to look at. We actually just, you might have just logged on. We just spoke about it. That's what this is trying to illustrate, and we speak about that in a lot more detail. We spoke about that on Thursday. So watch Thursday's lecture. So I don't have to kind of be too repetitive. But unlevered free cash flow is a simplification of the cash flow statement. It's super important. We spent a whole afternoon on that on Thursday. I call the second half of the class afternoon, although still morning, to really hone in on that. It's really important that you guys understand that because a lot of people end up memorizing this formula. It's not about memorizing it. A lot of people get confused about the signs. Just do what the cash flow statement does. It's a simplification of the cash flow statement. Okay, enterprise value is the sum of the two. This gives us enterprise value. Why is this giving us enterprise value, not market value? What do you think?
Well, it's based on our cash flows, not based on shares outstanding in the share.
It's based on cash flow?
Well, we're getting total present value of our cash flows just based on.
It's an internal value well calculating, but we mean
Be more specific. Be more specific. It doesn't answer the question.
Because we divide EBITDA.
We didn't divide EBITDA. Why is this giving us enterprise value, not market value? That is the question.
is at debt.
Because just to the cash flow.
Enterprise value, market value
Cash flow is a market value metric.
plus net debt. Or
We didn't do that. That's my point. Why do we not have to do that? You guys should know this. This is the first round banking interview question. It's very simple. It's what this is all about. You're going to kick yourself. I'm trying to think, is it because I'm phrasing it wrong? It's such a simple... Give up? Yes. Because this is based on unlevered cash flow. It's unlevered. It's before debt. Enterprise value is an unlevered metric, unlevered free cash flow. If you took cash flow and discounted it, cash flow includes finance activities after equity, after debt, then that's a market value. This is unlevered. This is before debt. So that gives us enterprise value, and we can build from enterprise value into equity value, into an estimated stock price by subtracting net debt. Let's subtract net debt, okay? Enterprise value to equity value. We got to pull net debt. I think we did it on the right? On the right we didn't do net debt, we did total debt. I probably should have put net debt right here. You know what I'm going to do? I'm going to do a little tweak here. What we did was we took equity value and we kind of built enterprise value by adding net debt, right? Cash plus short-term debt plus long-term debt minus cash. I want to show net debt as a separate line item so I don't have to pull it in again. So what I'm going to do is here in the enterprise value, this whole 021, so 021 plus 024 plus balance sheet, all this stuff, I'm going to separate out as net debt. So I'm going to put net debt here. And I just need to pull out 024, right? This is what I meant to do. I'm sorry. I should have done this here. I just pulled out net debt. This is our net debt, right? It's the debt plus non-controlling interest minus cash.
You can show the home number again, please.
Yeah, this was just a piece of the enterprise value formula. Cash plus non-controlling interest plus redeemable non-controlling interest minus cash. I just separated it out. So enterprise value is simply equity value plus the net debt. The enterprise value is the same number. I just added, I want to show what that net debt was because we're going to use it in other places. Instead of having to go into other formulas and recalculate net debt again. Okay. I just took the piece of the enterprise value formula that had 021, balance sheet F38, and I just separated it in its own cell, right? Because enterprise value is equity value plus net debt. I should have laid them out separately. I didn't do it in the book. I should have after working with it and teaching it. I mean, I talk about it in the book, but I didn't separate it. Okay, it's a formatting thing. The reason why I did that is that way when you say net debt, we don't have to calculate it all over again. We can just pull it here. I hate calculating the same thing twice. We just pull it in from here. Otherwise, I'd calculate it again. It's the same thing. I'm calculating it again, cause of error. And in equity value, we subtract. Okay? Good? And then, with this, we can figure out an implied stock price by taking the share count. Now, we pulled the share count. We already have shares outstanding over here. And we divide. $68. Based on our model, we think the company's target stock price should be $68 versus 73. What does that mean? This is how they do it. This is how they do it in Wall Street.
Recommended sell.
Yeah, we're recommending the stock price should go down. That's how you do it. That's what this means. This is an implied stock price. Now we're not done yet because we got to work on the WACC and things like that. Okay. Okay. Let's see how that. Let's do the same thing with the perpetuity method. Present value of cash flows. Present value of terminal value. Total enterprise value. Just try. I'm gonna. It's the same formula. I want to see if you guys know enough to do it on your own. And I'm getting it, bless you, a much lower $35. It just doesn't make sense. It's too low. But we got to work on the WACC number. So I want you to take a couple minutes to see if you can replicate that. It's the same thing. Just we're using the perpetuity method instead of the EBITDA method. So I'm going to stop. Okay. Now, this is low. It doesn't make sense. It doesn't make sense because we made up the WACC. Our WACC is off. Let's talk about an appropriate discount rate. Okay. So, you know, the whole point of discounted cash flow is discounting. Not the whole point. Part of the process is discounting the cash flow. There are several ways to discount the cash flow. There's several ways to come up with a discount rate. A discount rate is supposed to represent what the investor who's investing in the debt and the equity would expect to be returned. And we would discount future cash flows by the rate that the investor would expect to get back, the discount rate. And so the discount rate is based on expected return to the lenders and expected return to the equity holders. And we weight those expected returns by the actual value of debt and equity in the business, right? So when you look at weighted average cost of capital, we basically take a look at and we've tried to figure out, okay, what types of securities do we have on our balance sheet? And let's say simply, if we had debt and equity, if we had debt, I'll call it D, and we have equity, so this is very simple. I call it E, and we say, okay, well, what do the lenders expect to get as a return? What do the lenders expect to get?
Lender,
Yeah,
principal and interest.
yeah, interest. We just assume interest. Tax impacted, times 1 minus tax rate. They expect interest, times 1 minus tax rate. What do equity investors expect to get back?
Dividend. Dividend.
They expect more. They expect stock appreciation.
Capital.
That gets a little bit more complicated. So we'll talk about ways to try to estimate that. The idea is we figure out some sort of lender rate of return, and we figure out some sort of equity rate of return, right? And the lender rate of return we consider as cost of debt. Equity rate of return, cost of equity. The cost of debt, cost of equity. The cost of debt to us, it's a cost to us, it's a benefit to the lenders. Cost of equity is a cost to us, benefit to the equity holders. And we weight those percentages by the actual amount of debt and equity in our business, right? So the proportion. So in other words, debt divided by debt plus equity, I'm weighting the average, times cost of debt, times 1 minus tax rate, is the portion that goes to lenders. Weighted average. We add it to equity divided by debt plus equity times cost of equity. That's the weighted average cost of the capital. That's what it is. Okay, so, and just for people online, I didn't record because we just did a lot of kind of paper drawing. The whole theoretical understanding of why a WACC is what it is. What we're going to do now is we're going to actually apply it in Walmart. And if you want more information, I go through it in exact detail as we just did it in the reading that I'm going to give you today and tomorrow. So let's take a break. And then what I want to do more importantly is build the WACC in the model and show you resources where to get it as an analyst. If you're interested more in the theory, it's in the chapters. I do recommend to understand though for interviews because they will get into that. They could get into that topic, especially if they know if you put it out there that you know it. So let's take a 10-minute break, and then we're going to go into building the WACC and then take it from there. Okay, so I want to talk about applying the WACC formula in the model. And as an analyst, like I mentioned, I talked a little bit about the theory. I'd recommend to read it again in the book. I think it's important to know, at least at this kind of scratch the surface level, because from my opinion, it's enough to know to kind of talk about in interviews and to try to be impressive at interviews. And it's enough to know to have an understanding as to what's going on with the WACC. But as from an analyst perspective, you really just know how to physically do it. And so here I have a cost of capital box here. And the first thing we want to do is build up the cost of equity. So we talked about the formula for cost of equity, which is the risk-free rate plus return on the market minus risk-free rate times the beta. One thing I forgot to mention, the return on the market minus the risk-free rate is called market risk premium. This is the premium. Don't confuse the market risk premium and return on the market. The market risk premium is the spread. A lot of people confuse that. Don't get tricked in interviews. He's figuring out. So yeah, you're good. So risk-free rate. Yeah.
What was the last part? Don't mix it up with what again?
Don't mix up market risk premium with return on the market. The premium is the spread. If somebody gives you, and I'm going to start giving you guys case studies for the next 2 days, return on the market, don't use that as market risk premium. You've got to calculate the spread. So we'll see that. Risk-free rate. Where do we get it? U.S. Treasury. Let's pull it up.
Market rate. Pull out the market rate.
So this is MRP, market risk premium, and we're going to get the risk-free rate right now. So you can get the risk-free rate from U.S. Treasury. I'm just realizing we don't have the screens. And so I'll just do Treasury rates. And here come, I just Googled Treasury rates, and it tells you right here, although I like to pull it directly from treasury.gov, daily Treasury yield curve rates. I like to do a 30-year analysis all the way through, okay? Okay, and so 30-year is 3.08 as of February 1st, 17. So that's the number we would put in there. Now, I do want to match the book, and the book was done a couple years ago. So in the book, I had pulled .93%, okay? So let's use 2.93%, but just know this is where it comes from. It would have been 3.08 if this was up to date. This is 2.93, okay? Now, market risk premium is the return of the market minus the risk-free rate. What we look at for market risk premium is an average of the market returns over the past 5 years, the past 10 years, the past 20 years, the past 30 years. And there are a couple of consulting companies and data companies that pull that information, and what they do is they actually calculate the spread from the risk-free rate at that time. So it's probably a lot more robust than if we did it on our own. So one company is Ibitson that we use at Morgan Stanley. They were a paid, very expensive, I guess, service that had that data that we used. And believe it or not, the market risk premium actually doesn't change much at all. Like in Morgan Stanley, Goldman Sachs, back then we used 4%, and we probably used that for my whole 3 years as an analyst, and then when we used 4%. Never looked it up again. That was just what was used globally. Now it's changed. It's probably around 5.5 to 6, but it's been pretty static like that for the past 10 years. So it doesn't move that much. So where can we get that? I'm going to show you a great resource. Demoterin, he's a professor, NYU professor, has a great, I think we spoke about this before, has a great website. Even at Morgan Stanley, yeah, even at Morgan Stanley, we used his site, we emailed him, he's very helpful. And he has a section called Data, where he's got his students or whoever does it, his TAs or whatever, pull a bunch of very helpful global data. So for things like, well, what's the market risk premium in, any different country, he has that information. He's got good industry average multiples, good things to cross-check. A lot of data. If you ever wanted kind of things that might be difficult to pull or might take expensive resource to pull, he has good first cut analyses on that. So current data. Yes.
Just going back.
Yes.
Related to the data.
Yes.
Because we need the covariance of the company and S&P 500 if it's a listed company.
Yeah.
But how do we calculate if it's a private company?
Okay, well, let's, when we get to betas, ask that question again.
Oh.
I just don't want to lose. So risk discount rate. And they have betas by industry, averages, which is really the quick average. The quick answer to your question is you would look at competitors' betas. You wouldn't know. You would look at competitors' betas. Valuing a private company is something we're going to talk about in LBOs. But that's the short answer. But we'll talk about it a little bit more in a second. So they have, okay, they recategorize this a little bit. They had, and I referenced it in the book, but they restructured this a little bit. They had market risk premiums. You know what? It's probably buried in cost of capital. Risk premiums. Here we go. Risk premiums. All right, scroll. Here we go. Yeah, here's all the risk premiums, all different countries. Okay. If you go down to the U.S., they had, interesting, changed to 5.69. That's the risk premium. Okay, 5.69. I mentioned to you it was between 5.5 and 6. Actually, in the book a few years ago, it was 6 at the time, so it's gone down a little bit. So let's use 6 to match the book, but this is where you would get it, okay? And it's pretty static. Okay, beta. Beta, as we mentioned, is the covariance of the asset that we're valuing, so Walmart versus the market, divided by the variance of the market. And so we would we're going to look up betas, but we'll learn later how to calculate our own betas. And what you basically do is you basically download, take historical market. I don't have the file. We could have done it now. Maybe we'll do it later this week. But you download the past 10 years of historical prices, the S&P 50 versus Walmart, and we'll calculate the daily returns, and we'll just do the covariance and variance formula and divide. That's what we would do. If the company is private, then you have to kind of question why you're doing the cost of equity, because the cost of equity is the implied stock price. Is it going to IPO? If the company is private, the concept of cost of equity is going to change, right? Because, for example, like if the company is private, because you're doing an LBO, has anyone looked at LBOs yet? What's the cost of equity for an LBO analysis? This is a private equity investment banking question. What's the cost of equity? What would the cost of equity be in an LBO for a company that you're LBOing? You either know it or you don't. What's the cost of equity represent?
The return.
And what's the return in an LBO? What's the IRR? What's an expected IRR? Yes. For a fund?
What's exactly?
Yeah.
Anything about
25%, let's say? That's the cost of equity. A lot of people overlook that. A lot of people think about getting into their head in all this valuation, and if you're an investor and you're expecting a 25% return, that's your cost of equity. It's your expected rate of return. So if you're looking at a private business, you want to think about what's that rate of return? Who are those investors? Because here, the idea of the cost of equity is, all right, there's 3.6 billion shares outstanding. $3.6 billion shares outstanding, and we need to know what they expect to get as a return. We need to figure that out. If it's a private company, who's the investor? Are there any equity investors? Is it the family? Well, what do they expect to get as a return? All this analysis is kind of for naught, is meaningless, because this is a public market perspective. So do they have preferred security? What do they expect to get back? What's reasonable for them? Or are they lending debt? If they're lending debt, the debt lending is an interest rate. So you kind of have to think about it from a different perspective if it's a private company. Good question, important one. For now, a great first cut is going to Yahoo Finance. Go to Yahoo Finance. They post betas there. It's first cut. Internet is slow. This is slow. If I pull up, let's say Walmart, it should be right in their key statistics section. So if I go and I pull up, there you go, Walmart. Okay. Stock price is down a little bit. And I go, There it is, beta. Minus 0.03. Why is it a negative beta? That's crazy. Okay. But that's what you would use. Okay, now, again, I'm going to go to the book just so we can match the numbers in the book. In the book, the beta was 0.42. Let's use that in the book, okay? 0.42. Okay? And so the cost of equity is simply the beta times that market risk premium plus the risk-free rate. 5.45. Is that high or is that low? You say low. You say, why do you say high? Why do you say low?
I say low because I'm again comparing it to what the market would do. So if my expected return is 5.45, it's a bit too low for equity.
Ordell, why do you say high?
Because when we look at the other
Mm-hmm.
the market, it works on something.
Yeah, it's a high risk-free rate compared to some other countries. Some countries might have zero risk-free rate. So you could think of it that way. Yeah, but I mean, if they're lending, it depends. I mean, if their debt is like 5-6%, which I think we had it, and this is lower than that, then this is pretty low, right? Remember, if equity is more risky than debt, you'd expect a higher return on equity than debt. Otherwise, investors would shift to lending. What's knowing the variables? What is technically making this low? What is technically making this low, knowing the variables?
Beta?
Could be, right? It's trading at 40% of what the S&P 500 is trading at. The S&P 500 is growing by 15%. It's 40% of that. Whereas if the beta was 1, if it was trading in line, cost of equity is 8.93, much higher. I think an average beta is what, 1.5? For an aggressive, that's 11.93, 12%. People say a safe cost of equity range is 12 to 15%. You'd want it to be kind of in line with S&P 500, 12 to 15%. It's a safe cost of equity range. But it's not unheard of for a company like this to be low. Why is it low? Is this expected? Why is it low?
Because it's less risky.
Why is it less risky stock? Because the beta is low.
No, I think first, Walmart is more stabilized company.
Yeah.
Whatever the business does, is people need it.
Such a big, stable business. Low volatility. It's not going to be the one that in the S&P 500 has a lot of high kind of volatility, right? There's a balance in there that this is an average. If the S&P 500 on average is 15%, there's going to be a few companies that are trading much higher, a few companies that are trading much lower. The big companies are going to have a little bit more balance to them and will probably have a lower beta. You got a question?
Do you get the cost of equity by calculator or you just type it?
No, I calculated it. Did I calculate it wrong?
Yeah, I think so.
That's right.
Okay. I think you got it right.
That's good. That's what we got. Oops.
You just have to beta.
Yeah. We're good. Cost of equity. Now, cost of debt. Interest rate. Now, be very careful here. WACC, we want today's investors' expected rate of return. That's why we're going to base equity off of the current equity value, not stockholders' equity. We want as current a measure of debt as possible. So ideally, you want to pull up current debt rates if they're tradable in the open market. Where do we get that from? Your favorite resource? Morningstar.
Yeah, that's why I said I go more before the classes.
So you go Morningstar. Morningstar, Walmart, debt. Okay, Morningstar is a great place for that. Now, if the company, a lot of companies don't have tradable debt. If they don't, then fine. Then you can go to your model. But just if you go to your model, don't use a weighted average of debts. Look up the most, because sometimes the debts could have been outstanding for 10 years, and it's an old interest rate. The idea is you want the interest rate, if the company were to raise stock debt today, what would basically be the interest rate? So, exactly. So Walmart, is this the debt bond rates? Most recent current yield, and if you pull it right, Morningstar is a great place for it. Bonds, here we go. Right up top. Okay, nope, scroll down. This is taking its time. You should pull up a list of the more recent bonds. Okay. So 4.12%, pretty low. Okay. Now, just to match the line at the book, in the book we had 5.625. Okay. So let's go 5.625. So cost of debt 5.625. Okay. And we now have enough data to calculate the weighted average cost of capital. Okay? So, weighted average cost of capital, big formula. We're weighting capital structure. So equity, which we did here, equity value, divided by sum of debt, sum of the debt and equity, not net debt, total outstanding debt. So it's the sum of the equity plus the debt outstanding. That's the weight. That's the equity weight. Times cost of equity. Plus the debt weight. Debt divided by the sum of the debt plus equity. Oh, no. Times cost of debt times 1 minus tax rate. And I'm going to go to the income statement and use, I don't remember if I used 33 or the 32.6. I mean, it's going to be 5 point, hang on. Okay, I don't know why my number is a little bit different. 545, 5.625. Everything looks good. Did I have a mistake in my formula? O24 divided by O24 equity plus debt times L24 cost of equity plus O21 divided by O21 plus O24. Sounds good. Times L25 times 1 minus tax rate.
What's the cell for income statement, the D26? I see a difference on mine. That's why.
Oh, so maybe I pulled the wrong cell?
Yes, possible.
Oh yeah, G26 is nothing.
33.
Oh, 34. Oh, that's weird how that happened. Okay, thank you for helping me there. I see 24. I just pulled the wrong row there. Okay.
Good.
Okay, 5.15. Now I had 5.16, so I wonder if I had pulled the year before. Yeah, I had pulled at row F, column F interest rate. I guess my perspective was that that's just the defined tax rate. I took LTM versus future year one. I don't know how much a 0.01 difference can make, but just if you want to match the book. I took tax rate from, I took this one, not this one. Yeah. Okay. We're going to now apply that rate here. So our rate was way too high. Now let's talk about what that means. 5.16. That's our new WACC. Okay? You guys got that? No?
Something weird happening.
Something's weird happening?
Yeah, I don't know if it's the particular references, but I don't know why my enterprise value is 0 and my WACC stuff is 0.
Okay. What does this mean? Look at this. They fell a lot more in line, didn't they? 88 to 95. Better than 60 to 30. Made a completely different picture. Like I said, it's good to look at both these methods and cross-check. Now, at the time, the company was trading at $73.82. So this could imply what? What's going on here? Good. Stock price could be headed up. What is it based on? Let's put it this way. What's the difference between the EBITDA method and the perpetuity method? What if one was, this is kind of in line, what if one was much, much higher than the other? What if the EBITDA method was much higher than the perpetuity method? What would that mean? Knowing how it's calculated. What could that mean?
EBITDA accounts for depreciation and amortization, obviously.
Yeah. How does that help answer the question? No. Think it through. Keep talking it out.
I think the biggest difference is coming from the present value of the terminal value and the total enterprise value.
Yeah, and that's what we're comparing. We're comparing the two.
The two.
Yeah, what? Because this is based on the EBITDA method. This is the perpetuity method. These methods are terminal value adjustments. What would you imply? Give up? How are you thinking about it?
Think about how we got the enterprise value
Yeah. Well.
on both methods.
Yeah.
So taking the EBITDA method, we have the equity value coming from, the enterprise value coming from the debt and the equity value. And the equity value was calculated again
What do you mean?
by the stock price
Mm-hmm.
and the shares outstanding. Was
What do you mean it comes from a debt and equity value, though?
the formula for enterprise value that we got for the EBITDA method. Looking at that formula, that's what I meant by
Well,
debt and equity value.
the only difference between EBITDA method and perpetuity method is this, right? Which is driven by this versus this. It's the terminal values. So if the terminal values were way off like they used to be, right? Way back before, the EBITDA method the terminal value was much higher than the perpetuity method. What would that mean? What would cause that? How would you think about that? What drives the EBITDA method? Do you know what drives the EBITDA method? What's the variable driver? Where's it come from? Nope. Nope. How'd you calculate it? And? Multiple. Versus the perpetuity method?
Growth rate.
Growth rate. What else? What else? Growth rate.
The WACC.
WACC drives them both. That's going to be another factor as well. That's another factor as well. No, it's important. What else? What else impacts perpetuity?
The unlevered free cash flow.
Unlevered free cash flow. So the EBITDA method is based on the multiple, the EBITDA, the multiple. Perpetuity method is based on the cash flow and the growth rate. So one is very market driven, really driven by the market. The multiple is 12, we would have a totally different picture here, right? One is driven on our underlying cash flow, our unlevered free cash flow. So looking at these two side by side do say a lot about company valuation from a DCF perspective. Remember, DCF is seen as kind of more technical with a couple of exceptions, right? The exception is that the terminal value, we always said, is like 80% of the value. And as technical as the first 5 years of cash flows are, a terminal value, which is a big portion of it, is not as technical. It's not really as based on our model. Kind of is. So if the EBITDA and perpetuity method is out of whack, if the EBITDA is much higher than the perpetuity method, thinking that the perpetuity is really supported by our cash flows, more supported by our model than the EBITDA. The EBITDA method is supported by the multiple, which is market-driven. Maybe the company is overvalued. If the value of our cash flows is giving us a much lower valuation than the EBITDA, a lot of people are pushing up the multiple. That's one way to look at it. Other way to look at it is, if EBITDA is much lower than the perpetuity, meaning we've modeled out cash flows that show the company has this high value, right? But based on the market, it's much lower. Maybe the company is undervalued. Maybe our model is way too aggressive. And this is really interesting because not a lot of people compare these two, and a lot of times if people see differences in this, they're like, oh, there's something wrong, there's something wrong. Sometimes there's something right in terms of the market's in a flux in some way. So, for example, it was back in 2009 when, before we had the school, we used to kind of go around to firm to firm to firm, and we'd teach the analysts, we'd teach the banks coming in, and we always do evaluation on their banks. In 2009, hands down, the EBITDA method gave a much lower value than the perpetuity method. Why? It was a market recession, multiples were low, and people were not paying for what was actually supported by the cash flows. And every time I've saved all those models, when I redid them 3 years later, it came back. And now everything's in line. Which means if you see a situation where the EBITDA method is much lower than the perpetuity method, companies producing all this cash, the market doesn't see the value. It's buy opportunity. That's a buy opportunity. So a great window into how these technical analyses can really be utilized to determine approximate value. Now here, they're kind of in line, which is okay. Right? So they're hand in hand, I think. Yeah, hand in hand. Yeah. And this could change a little bit, but in both scenarios, it does look like the stock's going to go up a little bit. And when we dig deeper, and I concluded in the book, and we'll see why, you know, I concluded the stock's going to go up a little bit, and then it's going to drop. And it completely did. It went up. It hit like, I'm thinking this I went to back. Actually, if you look at it, I think it went to like 86, 87, and then it dropped. Now it's at 66. It did exactly what we thought it would. I wonder what happened to it. This was about years ago, right? Yeah, it hit 80. It did hit 88, 89. Perfect, and then it dropped. And then something else happened. Then there were some headline risks. We would have had to redo the model back then. But these analyses are really helpful in that fact. So, DCF, real important. Next exam is going to be all about the DCF. We're going to learn about comps and P-PAIDs, but that's more of a process that you need to know for talking about in interviews. It's not something I'm going to test you on, only because in a first-round interview, what you're really grilled on is DCF stuff, how the WACC works. When I say you need to know for interviews, I mean I want to make sure you know how to do comps the right way so you can say you can do it, but no one's going to kind of grill you on, you know, specifics within it. They just want to know that you know how to walk through it, so we'll do that. But really, really focusing on understanding of DCF. So for the next couple of days, I want to kind of do some case studies, paper case studies, that are indicative of what you'll see in the next exam. I'll talk more about it. Case studies are going to be a little bit more, a little bit different. I'm going to give you a bunch of variables. We're going to talk through it, and I want you to build your own DCF model first on paper, because that's the way these case studies are done. And it's so important because DCF model is based on EBITDA projections, building working capital, depreciation schedule. It'll really hone in on all your understanding of what we've done for the first couple months, but you'll look at it in a much simple form, and it's going to be tricky. But just try to make it on time, because if you come in midway and you miss the variables and you guys are working, it's going to be tough to catch up. So, but it's good. It's good practice. It's good exercise. We'll do one tomorrow and maybe even another Thursday. I might spend the next couple of days on it. Let's see. I'm going to balance it, and I'm going to give you back the tests, and we'll talk more about that tomorrow. Okay, good. DCF, Chapter 7. I'll send you the reading.